Yes, sir. Good evening and a very warm welcome to everyone joining us today. We are very glad to have you us all here with us, and it's a very important topic that we are going to discuss today. And it's none other than corporate tax, a buzzword that's all across in UAE these days and beyond as well. We can see that there is a lot of interest, not just within the UAE, but outside. In Pakistan, I get queries. In India, also, my friends are around. They are very much keen to learn about this one. And this is the first time our TSPD committee in UAE is organizing this webinar. And we have two very specialized, very learned speakers on this topic. And this is the first one. And I am the chairman of the TSPD committee in UAE. And with me in my team is Mr. Arshad Malik. And we are supported by our branch team, and it is led by Mr. Rizwan. So without any further delay, I will request the team for the recitation of the Quran.
أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم الحمد لله رب العالمين الرحمن الرحيم مالك يوم الدين إياك نعبد وإياك نستعين اهدنا الصراط المستقيم صراط الذين أنعمت عليهم غير المغضوب عليهم ولا الضالين.
Ameen. So I'll just briefly give you the way how we'll conduct this webinar. First of all, we will have few remarks from our chief guest, President of ICMAP, Mr. Ghulam Mustafa Qazi. And afterwards, I will introduce you to our two of the esteemed speakers. And the both of the speakers, they will take around 30 to 35 minutes, and they will go into details of the corporate taxation topic. And afterwards, we will have a question answer session. And followed by the question answer session, we will have a vote of thanks, and then we'll close the webinar. So, first of all, I want to say thank you so much, Mr. Ghulam Mustafa Qazi Saab, for getting some time. And today we know that it is like Sunday. It's the day when someone is like, we are getting ready for the next day to go back to the work. And also it's a day where we have like India versus Pakistan cricket going on, and also you're super busy. So thank you so much for joining us, and over to you. For we are very much wanted to hear your remarks on this, on first activity from the UAE branch council on the technical side.
Thank you very much. Bismillah ar-Rahman ar-Rahim. Distinguished guests, honorable speakers, and dear participants, Assalamu alaikum wa rahmatullahi wa barakatuhu, and a very good evening to all of you. It gives me a great pleasure to welcome you to today's webinar on UAE corporate tax. This is indeed a timely and highly relevant topic, as UAE's corporate tax regime marks a significant shift in region's fiscal landscape. People all around the world, as the host of today's event already said, they are asking for a training on UAE corporate taxation, because many of the people, not in UAE only, but also in Pakistan, India, and around other countries, they are interested to provide the taxation services and the consulting services to the taxpayers in UAE. Businesses, professionals, and policymakers alike are keen to understand its scope, compliance requirements, and long-term implications. The objective today is to provide clarity, share expert insights, and engage in a meaningful discussion that will help organizations prepare effectively for the new era of taxation in the UAE. I am delighted that we have with us distinguished speakers and the experts who will guide us through key aspects of the corporate taxation, the compliance obligations, and the opportunities this change presents for the businesses operating in UAE. Before I hand over the mic to our moderator or the speaker, I want to thank all of you for joining us and contributing to this important conversation. Having said this, the Institute of Cost and Management Accountant has always uh, been very keen in imparting education not only to the students but to the members of the institute. And in this area, the CPD committee has been very proactive. Apart from CPD, many other committees are also uh, getting the knowledge imparted to their members as well as the members at large. Technical Sport and Practicing Development Committee was established in the first era of my first election as being National Council member. And the first agenda item which I presented there was to establish a committee for the benefit for the capacity building of the practicing members. And since then, it has done remarkably well by imparting training, by providing them with the crucial documents and the guidelines about how to start practice, how to develop their practice, and how to provide the crucial services to their clients. Apart from this, the institute is flourishing day by day. Apart from the 13 campuses in Pakistan, we have about six international offices, which we are trying to expand. And our international branch councils are really a very much helping hand for the council as well as for the institute. Thank you very much for the UAE branch council for arranging such trainings for the members, which are helpful for the members at large. Thank you very much. So let's begin our session and move forward for our first speaker. Over to you, Mr. Host.
Thank you, President Sab. So now it is my distinct honor to introduce our esteemed speakers. And first, we have Miss Angela Andre, a seasoned professional with over 2 decades of experience all across GCC and in Europe. She is a professional and she brings in a wealth of financial as well as strategic expertise to the table. And she is MBA, FMBA, and ACCA. So she is like a with GCC, and on the taxation side, she has a very good grip. Our next speaker is Mr. Muhammad Omer, who will follow Angela's session, and he is a CGMA. He's a director finance in one of the group hotel hospitality group, and he himself like have implemented the taxation structures and all across multi-entity group. So he is very much into the implementation side as well, and he is will give us like practical side of the corporate taxation. So with this, I will hand it over to Miss Angela. Miss Angela, over to you.
Thank you. Good evening, everyone. First of all, I would like to express my delightful feeling being invited as a speaker in front of so many attendees that were allocated their precious time for this training. And also to thank you to TSPD Committee and the ICMA International UAE branch for organizing this webinar. As my colleague was introduced me, I have experience in Europe. I was the finance director for European division with 12 countries in responsibilities, which was giving me a very deep insight in multiple region taxation. And I was also part of the implementation of these taxation strategies.
Angela, your voice
Therefore,
is little low. Can you raise your voice, please?
yeah, yes. This practical experience was helping me to understand very well the taxation in UAE. And what I want to offer you today here, it is the strategic CFO and the finance director's perspective on the compliance and governance. And I hope that my experience is going to help you to achieve a perfect compliance and the structure in your organization. So I will present now my presentation. Corporate tax is not just another reporting requirement. It is a structural shift on how the businesses in the UAE plan, govern, and allocate the capital. This session will position you as the finance director or a CFO as a strategic architect of your company or group tax framework. Our objective today it will be the followings: to translate the legislation into value decision and not just the compliance task, identify the leverage points in group structure, cash planning, and intercompany flows, prepare you to speak confidently at the board table about the CAT risk, opportunities, and strategic trade-offs. We will be referencing some articles from the law, but our focus today is on what these articles mean for the enterprise value, governance, and risk mitigation, not just the filling forms. The end goal of all finance professionals it is to protect the profits, to optimize the cash, to enhance valuation, and strengthen the governance credibility. Why this matters? Let's be clear, the corporate tax is no longer a back office item. It is now standing on every single board agenda. The law have directly impacts on cash flow. 9% tax of profit will imply the liquidity modeling is mandatory. Group design, evaluate the tax grouping, holding structure, cross-border flows. The CFO can unlock the cash savings through proper planning. Group design, evaluate the tax grouping, holding structure.
Sorry for the interruption. Angela, are you sharing your screen?
Yes, yes.
Is
The
it
screen not
visible?
visible now.
It's not visible.
Again.
Shafiq sir, can you help us on this one?
Click share.
Can you see now?
Yeah, is it visible now?
Okay.
It is visible now.
Green?
Yeah, we can see it.
Okay, I'm very sorry. I think it was just stuck. Okay. Why this matters? So we have been here. There are major impacts on the cash flow. 9% tax profit will require the liquidity modeling. Group design will have to evaluate the group taxing, the tax grouping, holding structure, cross-border flows, and CFO can unlock the cash savings to planning. Valuation is also very important because a clean tax record, it's a key factor in due diligence and investor confidence. And on the risk side, we have to remember that FTA is active, using immigration and banking data to detect unregistered permanent establishment and also management control cases. Management control cases meaning management of the enterprises from UAE. And also the penalties are escalating quickly. Late registration and late filling start with 10,000 dirham and grow monthly. Your job as a senior finance professional is to move the conversation from what do we file and how do we position the tax as a strategic enabler. Today agenda, what I want to cover in big lines: scope and applicability. Clarify which entities and income streams are captured under the CIT and why. Compliance roadmap. Deadlines, high-level review of the registration, filing, and the penalties, strategic levels that we have, how you as a CFO or a finance director can use the tax grouping, loss transfers, financing structures to reduce the cash flow. Transfer pricing and connected persons, it's a key audit hotspot for 2025 that is impacting deductions and intercompany flows. Risk and governance heat map, how we have a clear impact on the P&L and also the balance sheet, exposure that we have to learn and understand how to mitigate it. And the last, it will be a CFO action plan, which is the clear checklist to take back to the board and execute over the next 12 months. So we are moving from the compliance to a control tower, and our scope is to leave you with an integrated view on the CAT risk and opportunities. Scope and applicability. Scope is where most of the CFOs underestimate the exposure. Resident juridical person are all UAE incorporated entities and branches, and they are taxed on worldwide income. Resident natural person are natural person conducting business activity with a turnover over 1 million triggering the registration. Non-residents, they are taxed only on UAE source income via a permanent establishment or a nexus. What are our strategic watch-outs? If our company is incorporated abroad, but the board meeting and the key decision take place in Dubai, you may create a UAE tax residency, pulling global income under the UAE tax net. So it's very important to understand that. Construction projects longer than 6 months, they will create PE automatically, and you have to take an action and budget for the tax and for the registration. Nexus rules will capture income from UAE, allocated assets, and immovable properties. What is the CFO action? The CFO action is to run a legal entity and control mapping, confirm the TRN status on every entity and the branch in UAE, identify foreign entities effectively managed from UAE, and use double tax treaties where available to mitigate the double taxation risk. The UAE has kept the tax rate very simple, but there are a lot of nuances that we need to understand. Zero tax rate applies to the first 375,000 dirham on taxable income, and this is supporting the startups and small business enterprises. 9% it is applied to all taxable income above 375,000 dirham. There are multiple SME reliefs. If your revenue is under 3 million, you can elect to be treated as having no taxable income until December 31, 2026. This is a very powerful planning opportunity for small entities. But on the other side, we have the general anti-abuse rules that will empower the FTA to recharacterize arrangements if they believe that you have split the entities purely to exploit the 0% band. There are strategic implications here. You have to model, as senior finance professional, the effective tax rate across your group. From some of the companies, early formation of the tax group could offset the profits with losses and reduce the tax liability. For others, shifting where the certain costs sit may optimize the taxable income. I will review very briefly the exempt persons. What I want you to watch out here, it is that the exemption is not perpetual and the breaches can backdate liability of the tax. Who is auto-exempt? No government in this world is going to tax their own activities. Governmental control entities, they will have mandated activities, but if they are performing commercial activities, these are not going to be exempt, they are going to be taxed. Extractive and non-extractive businesses, they have a special regime, they have to be licensed, they have to pay taxes at Emirat level, and also they have to inform MOF that they pay another type of tax and they are going to be exempt. It's not automatic exemption. Public benefit entities, they are going to be listed specifically under the Cabinet Decision 37, and they are obliged to pursue only charitable activities. Funds and pension are regulated funds and social security entities, and they have to apply for FTA for the approval and to comply with specific restrictions. I think a point of interest will be the free zone regime, which is quite complex and for which I'm recommending you to read in detail the guideline that will give you clarity on all the exception and how to calculate your non-qualifying and qualifying income. It's a major opportunity, but also is coming with very strict condition. A qualifying free zone person must be incorporated in the free zone, maintain adequate substance for people, premises, and decision-making, earn qualifying income from defined activities which are listed, and comply with the arm's length pricing and maintain the transfer pricing documentation. On top of that, they have to prepare audited financial statements and calculate permanently their threshold with the minimus for non-qualifying revenues. If they are exceeding the minimus, if they are breaching substance or transfer pricing rules, they are losing the qualifying free zone person status for the tax period in which they are exceeding plus 4 years, so in total of 5 years. The CFO action here, it is to implement a quarterly compliance dashboard that will monitor the revenue mix versus the minimus threshold, substance metrics for staff count, decision minutes and office leaves, and audit readiness. This will allow early remediation before a breach triggers the 5 years of higher tax. Resident and non-resident persons. Asha, do you want to say anything?
Yes, Miss Angela, people they are complaining regarding your voice is very low. They can't hear properly. Can
Okay.
you
No
little
problem.
increase the voice, please?
Yes, please. Yeah, I will.
Thank you.
Sure. Resident and non-resident persons, we have to understand the residency very well to avoid the accidental taxation. Resident juridical person include all UAE incorporated entities and foreign entities with their place of effective management in the UAE, and they are taxed on worldwide income. Resident natural persons are natural persons conducting business activities in UAE, and they must register only if their turnover is above 1 million dirham. Non-residents are taxed only on UAE income derived via permanent establishment or nexus. Very important, FTI is actively reviewing the cases where boards and management meetings are held in UAE for foreign companies. If you are directing a foreign operation in Dubai, you may create UAE residency. We have CFO actions here. First, we have to conduct management and control assessment, review where the board's decisions are documented, map the revenue streams to UAE nexus triggers, and confirm the TRN registration for all PEs and branches. Permanent establishment. Permanent establishment rules are where many non-resident exposure arise. A fixed place in UAE, it's a factory, a warehouse, or office used regularly for the business. Dependent agent, permanent establishment, even without a physical presence. If someone in UAE concludes contracts on your behalf, the PE is triggered. Constructions PE applies once site presence exceeds 6 months, including for supervisory and assembly activities. The CFO action, it is track the project duration, and contract signatories across the group. For cross-border groups, establish the guidelines for who can bind the company in UAE. And the last one, registers the PE early and mitigate the late registration penalties. Registration requirements. Registration, it is our first compliance checkpoint, the first one. And we have very clear rules. All juridical person must register in 3 months after the date of the license issuance. For a natural person with a turnover of 1 million, they have to register for TRN. Tax group, it's a special application. These have to apply for a separate TRN and they cannot use one company TRN. And the 4 free zone entities, they have on top of that the requirement to file the annual qualifying free zone person declaration where they meet substance and activity test. The CFO action, it is to build a registration tracker for all their entities. Identify the joint venture or partnership that have to register and ensure that applications are submitted before the first return deadline. Otherwise, they will have to pay 10,000 dirham as penalties. Filling deadlines and the calendar. So we have already registered all our entities and we have the logs with the registration, which is the next step, and it is very close in practicality. It is 30th of September 2025 for the fiscal year or tax period 2024. It is the filling. Corporate tax return must be filed within 9 months after the end of the tax period. And the tax payment has to be done exactly in the same time, on 30th of September. You have the flexibility to align your tax period with your existing financial year, but once you choose it, you have to apply it consistent. It's recommended to have an early filling. It provides you what? With the cash flow visibility and reduces the last minute error. For large groups, coordinate across the entities to consolidated numbers and intercompany elimination to be completed well before the 9 months deadline. So what is the CFO action here? Create the tax compliance calendar and reminders for registration, fillings, payment, and transfer pricing submissions. And it has to be shared, commented, and updated with finance team. From the governance perspective, it can be created also a group-wide file calendar for complex entities. Record keeping. Here I would like to be a bit detailed and attentive because I have noticed in practice and implementing the tax that there is not a very high level education of all the accounting teams or all the members of the accounting team. It is the first year. It is absolutely understandable. There are guidelines in FTA that are telling you how to segregate the expenses. My practical recommendation, it is to structure your chart of accounts with separate sub-accounts for non-deductible expenses. It will save you a lot of time when you are adjusting the accounting profit getting to taxable income. This is a very, very practical application of the law. Create sub-accounts for every single item that will be part of your reconciliation. So every taxable person will have to maintain the accounting records and supporting documents for 7 years after the end of the tax period. We have to maintain IFRS compliant financial statements for every tax period. More, we have to retain contracts. Please create a library with your contracts. Invoices, if possible, please upload it in the system directly or save them digitally. Payroll records, intercompany agreements. I cannot underline the importance of signing the intercompany agreements. and working papers that will support your taxable income and deductions. Please ensure that your ERP and archiving system will allow very quick retrieval in case of the FTA audit. So what is the CFO action? Run a record keeping readiness check. Confirm that you can produce the required ledger and document in 48 hours. Penalties and anti-abuse rules. Of course, that penalties under the CAT law are real and they are already enforced. The late registration is 10,000 dirham. Late filing, 500 dirham per month for the first year and 1,000 per month thereafter, and is capped to 50,000. For the late payment, additional money, interest applies until it is paid. So they are building up, they are raising, so we have to take them into consideration. And beyond the monetary fees, it's also the general anti-abuse rule, which will allow the FTA to disregard and recharacterize the transaction that they consider how artificial. Main purpose was to gain a tax advantage. So there is no way they are not looking at this possible movements in the company. What is the CFO action? It will have to perform a general anti-abuse rule risk review on the group structures to ensure that every single tax position has a commercial rationale and proper documentation. Tax grouping and group relief are very powerful tools to optimize tax and cash flow. For the group tax qualifying tax group, there is the condition that the parent will own 75% direct or indirect on all subsidiaries. An entity with losses will be allowed to transfer the losses to another entity that has taxable profits. That means they will be capable to reduce the group tax liability. Tax grouping, it's much more stricter, will require 95% at least common ownership, same financial year, and uniform accounting standards. And the difference here, it is that the parent is going to apply for a separate TRN and will file one single tax return for the group. Exempt person and free zone person cannot participate into a tax group. So it's very important. And I want to answer here one of the questions that might be in your mind. Only the juridical persons can join a tax group. If you are not a juridical person, you cannot join a tax group. The CFO action here will be to build a grouping simulation model. Evaluate if forming a tax group lowers your effective tax rate. Consider timing. Grouping is prospective, and you have to finish your registration before the end of the tax period, not after. And you have to factor on reporting, governance, and intra-group pricing. Loss utilization and ownership test. There are many conditions in order to use loss, especially if there is a change in ownership and change in the business activity itself. Losses now, they are not just losses, they became a strategic asset and you have to manage them with care. Carry forward losses. Tax losses can be carried forward indefinitely, but you may offset only 75% of the taxable income in any year. Ownership change rule, very important. If more than 50% of the ownership changes and the business activity changes, carry forward losses are not allowed, not allowed. Pre-CIT losses are not deductible. So whatever losses you have before becoming a taxable person, you are not allowed to deduct them. What is the CFO action? Track losses by entity and confirm the shareholders registered regularly. If a change in control is planned, ensure that the continuity of the business activity. Why? To preserve the carry forward losses. From governance perspective, insert a prevention of loss clause in your sale purchase agreements. Ensure CFO approval for any share transfer more than 50%. Interest deduction limits. One of the biggest adjustments in the CIT is the cap interest deductibility. It's a direct impact on the financing structures. What is the general rule? Net interest expense is deductible only up to 30% of adjusted EBITDA. The minimum threshold, if your total net interest is under 12 million, it can be deducted in full with no restriction. Carry forward, we have a limitation here, is not like tax losses carry forward. Disallowed interest can be carried forward and deducted over the next years, next taxable periods, subject to a cap every year. And a special provision, it is for the loans and instruments in place before 9 December 2022, when the law has been introduced. It's called grandfathering. They can be excluded if there are not subsequent modification. The CFO action here, it will be to run a thin capitalization analysis. How? Model your EBITDA, confirm that intercompany and external interest remains within the limit. If it is above the limit, 12 million, consider equity conversion and refinancing to reduce the disallowance. Also document, I have seen in practice in a few companies, shareholder loans with zero interest. I recommend to document all the shareholder loans and ensure that they are at the arm's length pricing. Of course, that the tax is hitting many parts of our balance sheet, and there are errors done that will artificially reduce the taxable income. And unfortunately, if they are reclassified, penalties and the delays in payments will bring more expenses to the company. So we have to pay attention that the CIT has turned the balance sheet into a risk hotspot. For example, CAPEX versus OPEX expenses. If the CAPEX are misclassified as OPEX expenses, they can lead to disallowed deductions. Right of use assets in IFRS 16 ensure that your lease liability depreciation align with the tax depreciation schedule. Overstepping the deductions, it's a common error. Very important, because they require the CFO approval. Provisions, general provision for litigation, bonuses, warranties are disallowed unless they are contractually or legally obligated. Therefore, the CFO will have to revise and approve. And also impairments. Impairments are a tool to manipulate the profitability. Therefore, they have to be supported by IFRS compliant calculation, and artificial impairments will reduce the profit, will be disallowed. CFO action, conduct a balance sheet review every quarter. Segregate capital and revenue expenditure, reconcile versus tax and IFRS depreciation, and justify all the provision and impairments with documentation. For the free zone, I have explained a bit earlier, so I can skip it. Just I want to add a strategic layer. If your qualifying activity is producing a profit, it can retain the qualifying free zone person status, and rate of 0% will be maintained. I am recommending here to have a quarterly free zone dashboard that is reviewed by the CFO, where you are classifying all the activities that you are performing, the parties that you have transaction with, if they are mainland, if they are domestic PE, foreign PE, because all of this will attract with them qualifying free zone revenue or non-qualifying revenue. So it's very important to maintain the mix of your revenues. And if you have a very clear log, you will not miss this opportunity to remain zero taxed. And the last part of my presentation will address the transfer pricing. Why it is important? The introduction of the tax law in all GCC countries, and especially in UAE, it was an alignment of UAE with the OECD regulation and introduced a tax to avoid the profit shifting to tax havens. Therefore, it's really important for FTA to maintain the visibility of the prices that are applied between the related party. Transfer pricing is not an OECD concept. It is a key risk under the UAECT. What is important here? Arm's length principle. All related party transactions, being domestic or cross-border, must be priced as if they were between independent parties. Consequences for the non-compliance: non-arm's length transaction lead to disallowed deductions, adjusted taxable income, and even penalties. What is the scope? To apply, this is applying to service fees, management charges, royalties, interest, cost allocation, not just for cross-border, but also intra-UAE group. So please remember, including internal transaction in the UAE are subject to transfer pricing. CFO action: you have to map all the related party transactions, benchmark fees, salaries, royalties, company loans against the market data. What is difficult here? UAE do not have market data ready available because it was not required before. In Europe, where the transfer pricing, it's like business as usual, there are companies providing databases where you can benchmark all this. Here, it will be really difficult, at least in the first 2 years. Prepare updated transfer pricing documentation to support your pricing. And not only that, educate your executive team. Many groups are unaware that even domestic transaction must require compliance. Two important concepts in the transfer pricing are related persons and connected persons. The law make a big distinguish between this, and they also must be disclosed. So I underline, they must be disclosed. Related parties are covering the entities or individuals with common ownership, control, or kinship. Connected persons are broader, includes shareholders with 50% interest, directors, officer, and also the related parties of those individuals. Why does it matter? Because the payments to connected person, excessive management fee, salaries, shareholder loans must be at the market value. What the CFO has to do here? They have to create connected person register and related person parties register. List shareholders, directors, officer, related parties, and track payments, benefits, and intercompany balances. You have to document at arm's length rationale for each transaction because they are acceptable only if they are performed exclusively for the company. Disclosure requirements under the transfer pricing. Compliance is requesting only annual compliance, only annual disclosure. For the related party disclosure, it's mandatory if the total transaction exceeds 40 million in aggregate in one tax period. For connected person, the disclosure is required if transaction exceeds 500K in aggregate. What we do not include here, the dividends. They are not taken into consideration. Timing. When we have to have this disclosure with the tax return, in the same time with the tax return. CFO action: prepare a disclosure tracker, capture all related parties, connected person transaction during the year, reconcile it against the GL and the trial balance, and ensure the proper sign-off. Master file and local file. Master file and local file are core TP documentation. The master file will have a high-level overview, while the local file will have a granular detail for UAE entity. Which are the threshold to have them? It's very simple. Mandatory if consolidated multinational enterprise revenue it's above 3.15 billions. So it's quite relaxed for the UAE. And if UAE entity related party transaction are higher than 200 million. So these are the mandatory. They must be prepared when? At the first filing date, and it is refreshed not every year, but every single 3 years. When we refresh on annual basis, when we have a major transaction that is happening that has to be documented. Therefore, the CFO will have to engage the advisor very early because these files takes months to be prepared and align the internal data and budget for these annual refreshes. There are 5 methods that are accepted in UAE and they are applied for different types of activities. What I want to highlight here, it is that we need to have an annual transfer pricing validation memo and to store the benchmarking studies with CT return. And CFO will have to standardize the approach. So we cannot choose different TP methods and take into consideration to work with companies that are taking care of transfer pricing. Transfer pricing, risk and mitigation. I think that transfer pricing will be a very hot topic in FTA audit. And they will be top enforcements. There are multiple risks here. Salaries, royalties that are paid above the market rates will be disallowed. Interest-free loans, they will be reclassified as equity or dividend, and lack of permanent updated documentation will attract penalties. For the government's perspective, annual TP review will have to be done with external advisor, and board will have to be updated on transfer pricing risk in audit committee packs. We have a risk map here, and we have addressed almost everything. Is the P&L, non-deductibles, and also the chart of the account segregation, really important. Balance sheet, misclassified capex or error assets depreciation, tax reporting, missing TP documentation, and from government's perspective, I have addressed to every single slide that will compose or will make the composition of a very good governance framework. How to prepare for audit readiness? FTA audits will be a routine, and you have to keep your books and records to be produced in 48 hours. Maintain contract invoices, benchmarking studies, make the strict reconciliation, and take into account that FTA will compare the VAT returns with the tax returns and make sure that you are reconciling and you are getting to the same numbers. And run an internal dry run audit annually. Please make this effort that will prevent huge penalties from FTA. And the last, I hope that in my presentation, I was able to create for you a very clear action plan for the finance director and CFO, and not only because every single financial professional is participating from the booking of the transaction up to the filling and payment of the tax to the whole strategy. So your framework has to be very, very clear at all levels. So the first step will be register, get every entity, joint venture, TRN issued, restructure, simulate a grouping and loss transfer to optimize your cash, document, update your policies, prepare transfer pricing studies, assigning intercompany agreements, train and monitor. Thank you very much, and I will hand over now to our colleague Umair.
Thank you so much, Ms. Andrea. It was like a very detailed presentation on both the topics. First of all, you have given an overview of the UAE corporate tax, the key provisions, and taxable persons, all the definitions. And then you have also briefly touched this very big topic of transfer pricing. And thank you so much for making it easy for us. Given the time constraints, we'll now be quickly moving to our second speaker of the day, Mr. Muhammad Omer. As I've previously mentioned, Omer is serving as a commercial director, a corporate director of finance for the Shaza Hotels, and he has in-depth experience in implementation of the taxation. So over to you, Mr. Omer, and Mr. Omer will be mainly his topic will be impact of structure and text planning, and also he will be giving us a he will go through the corporate taxation in the filing part. Over to you, Mr. Omer.
Thank you. Am I audible?
Yes, you are.
Yes, that's
Okay.
clear.
And my screen is visible also?
It is loading right now, and now we can see it. So you can start now. Meanwhile, Arshad Saab, I'll request you if you can summarize the questions that the participants, like the listeners, are sharing on the Q&A platform. So after his session, we can have a quick Q&A session as well.
Yes, sure.
Bismillah Rahman Rahim. Assalamu alaikum and good evening, everyone. I would like to start by firstly thanking the respected President, Mr. Ghulam Mustafa, the members of the ICMA team, Asim Shehzad, Arshad Malik, Mohammad Rizwan, and other members of the team. Thank you so much, gentlemen, for extending this opportunity to share the UAE corporate tax knowledge and insights with the attendees. Secondly, I would like to thank all the attendees today, especially due to the timing, as well as because there is an India and Pakistan cricket match going on for the Asia Cup. So congratulations to all of you who are attending this session. You are making a deliberate choice to learn as opposed to temporary players. For certain people, of course, they want to enjoy life. So of course, they have their time. It's good that you are attending this session. It hopefully will bring some value to you. Thirdly, on another note, my wife basically tells me that finance in general is a dry subject and in specific taxation. While the first presenter of the day, I think she has very much presented some of the very good insights which are practical and must be executed from a CFO or those leading the finance teams. So I would also like to thank Angela for sharing those insights. Now, I'm required to present before me, actually, it's a huge task because the topics, they require a lot of time to go through and we have limitation of time. So I'll keep it brief, but I'll try to, zoom into those areas where certain depth is required. Some of the areas are already covered by Angela. So I'm going to, not touch base them. However, certain areas will still require to be focused. So what is the CT impact on the business structure? So I have classified my presentation into two sections. One, you can see above, is the impact on business structure, business, strategic tax planning, restructuring, uh, how do we claim the foreign tax credits, and implications for SMEs versus large corporates. As many of you would know, if you do a macro level analysis for the UAE market, between 94 to 95% of the companies which are here registered in UAE, they fall in the SME category. Rest are large corporates, and only 1% which have to follow OECD Pillar 2 guidelines, they are less than 1%. Very few companies there, but those are the big ticket items. The second section that I have to focus is the CIT registration, filing of the return and submission, and compliance framework. Part of it is already covered by Angela, but we'll see what are the other details to it. So let's move to the business. These are the five main sections from five subsections from the first session. Now, first thing we need to understand is a shift in the mindset is needed, because we are moving, or we have moved from a no corporate income tax to a corporate tax regime. People are still, or some of the people are still in the same mindset, it is okay, transfer this revenue here, move it to that entity. There is no compliance requirement, not much at all, so we can do whatever we like to do. That mindset needs to be shifted, because human beings, we are creatures of our habits. So first thing is that psychologically, that shift of mindset needs to happen, because the compliance requirement will make sure that you follow. So it is better prepared than sorry. So now UAE corporate tax will trigger taxable events, definitely. This also calls for, prioritization, and you can plan the opportunities accordingly. And the governance requirement, the structuring, you need to spend some time to make sure that you are in compliance. Now, we did cover this general anti-abuse rule before. Sorry, I think my screen is visible.
Yes, it is.
Okay. So Angela did talk about this general anti-abuse rule. Before I talk about business structures, I just want to emphasize the importance of this Article 50. Why? Because I will give another example, which is going to come in the next slide, where you can see it's just a matter of a shifting of revenues in another entity to take advantage. So it is important to understand GAR. If there is lacking commercial substance, there is some real issue. Uh, and basically, we have to focus on two things. There are two conditions. One, here you can see a transaction or arrangement is entered without a valid commercial rationale. So how do you establish commercial rationale? Now, imagine a situation wherein a business has to acquire another business. Of course, due diligence will happen. Now, there are certain big enterprises that they rely on in-house teams, because part of their job, especially in the private equities, they do it themselves, and they are very good at it, and they do the restructuring and then get the best out of the companies, and they have an exit strategy. So the thing is that part of the due diligence, it helps to reach out a commercial rationale. Secondly, if the main purpose is to come to an arrangement to obtain a CT advantage, and how one can take advantage, on the right side, you can see here that, these are the possibilities, how you can take tax advantage, starting from refund or advancement or postponement, those kind of shenanigans people can play. Then there is reduction, and worst thing one can do is either avoidance or evasion, and that is a criminal offense as per the law here, and it must be taken very seriously. Now here you can see that there is this one company, like free zone. She explained, Angela, a little bit, that for qualifying activities, there is a 0% corporate tax in the free zone. So provided that all the conditions are met. So company A is basically a mainland company. It sets up a free zone company and then starts routing its sales through company B. Now, there is no commercial reason. There is no real substance. It's just for the sake of taking advantage for this situation. They just set up a company from mainland to a free zone. Now, the FTA will try to understand what exactly happened. They have all the information, because all the information is routed and available within the government departments. They can reach out to other departments and get that information. And they can establish very easily that this arrangement was done to avoid the tax. And then they can do the adjustment, and penalties can then come. Now, of course, it's a spectrum that one has to go through. So what is the spectrum? On the left side, what you have is legal. Legal is tax planning is legal. You can do it. Some people call it tax optimization. Some call it that tax planning. which is within the compliance with the law. And towards the right side is tax evasion, which is, as I mentioned earlier, is illegal. So with this framework, we can now move on to understand what categories of structures can help or within the compliance which businesses can take advantage. But before I move to that, we talked about mergers and acquisitions. So on this slide, you can see business restructuring. So as per the UAE Corporate Tax Law, Article 27, it does allow business restructuring relief. Now, before we talk about what is business restructuring, uh, Corporate Finance 101, if you refer to CFA level 2, it's the curriculum, book number 3 and reading 23. If you go through that, it talks about the various reasons that companies do mergers and acquisition. At least 10 reasons are mentioned there. It can be for growth, strategic alignment, increasing their market power, bootstrap earning, so on and so forth. And one of the reasons mentioned there is uh, tax considerations. So one can take advantage through business restructuring and take advantage for the taxation. Now, this is very important because, as we mentioned in the previous slides, that there has to be a commercial reason, there has to be substance. So we also talked about that when due diligence happens, all that document should take place, which will then establish that business restructuring is done properly. And why tax consideration or this relief is given by the government. Of course, if you have to pay taxation on the transfer of a business, then it has cash flow implications. And at that point in time, the business might not be in that position. And for the continuity of the business, it might be required that this relief should be given. Now, on the left side, if you see, there are certain conditions that if a company fulfills those conditions, they are eligible for this business restructuring relief. So, just to name a few of the conditions for an entity to take advantage of this business restructuring. Now, it depends. If a group is decent enough and they are relying on their in-house team, and they have prepared a checklist, they can very well go through this before the acquisition takes place, so that they are aware. As Angela also mentioned briefly, that part of the checklist, it really helps doing the tax planning. So if those conditions are fulfilled, this relief, business relief, can be used, and it reduces within the compliance the tax to be paid to the government. So it has to be a taxable person. It can be a non-resident but has a UAE PE. It is not allowed for exempt person or qualifying free zone persons. They must have same financial year, same accounting standards, which mostly is IFRS, and there must be a valid commercial reason and must comply with the UAE legislation. So these are the overall conditions to qualify for this business restructuring relief. And there are certain considerations that one must take. So the consideration, it can be in the form of shares or ownership interest. It can include limited non-share consideration as well. And there are two rules for that: the lower of net book value or 10% of the nominal value of the shares issued. Then we have to talk about what are the types of the transaction. It can be, in the form of a merger, one company ceases to exist, and it can be the case that the company has certain divisions, and one of those divisions or slash assets is just sold. In those two transactions can take place. So how they take place is at the net book value, which we already discussed in the previous slide. Which transactions are not covered? Transfers during liquidation, transfer without consideration, these are not covered. And clawback provisions, because clawback provisions, it is just to protect. So protect the rights of the government, because if they have given the relief and the businesses are misusing it, because if there is no boundary to the game, then people or businesses, they can take an unfair advantage. So they have put a clawback provision of at least 2 years. Then compliance requirements are mentioned here. the transferor must elect to apply for this relief, and they have to have the documentation which provide the valid commercial reason, which we already talked about. The due diligence process should take care of that. So this is one area which is called business restructuring relief that the businesses can take. Uh, Now, another thing is that imagine a big business, they do spin-off and try to take unfair advantage. So again, GAR will kick in because, they for each entity, the 0% taxation up to 375,000. So companies can do that. Like, for example, if the total turnover of a company is around 10 million, they can split it in a way that they can take this small business relief. So there is a potential for that also. So again, GAR will kick in. However, let's talk about this small business relief. Angela already mentioned about, what are the threshold. It's 3 million of a turnover. If a business is doing that, then they can apply for the small business relief. So what is the benefit of this? The benefit is that, yes, they are still required to register, but they have to do a simplified tax return. They are not required to calculate taxable income, and they don't have to pay any corporate tax. So this is the benefit of getting election for this small business relief. So here there is an example you can see. Now, by the way, 23, of course, it's before the tax regime. So we have 24, 25, and 26. At least these 3 years, the company can take advantage up to 2026. And one important aspect is that if they were having losses during this period and they opted for this small business relief, they will not be able to carry it forward. Now, business A, B, and C, we can see that in all the cases, like A business has to pay around 2,000. You can see the numbers on the screen, how they are calculated. All of these are because the revenue is within 3 million, so they can take advantage of this small business relief. Now, here is the thing. Imagine the company is in 2026 and they have a loss. So they were within 3 million, but the expenses were, let's say, 3.5 million. So they cannot carry forward that tax loss in the coming period if they already opted for. And if they missed this threshold, they will lose a threshold of 3 million in a typical year. They will lose this small business relief also. Now we talk about this qualifying group relief. This is interesting because, like for the transfer of the capital assets between the qualifying group members, what are the conditions? They are already briefly talked about by Angela, but you can see them. This is between the juridical person. They have to be taxable person, ownership are more than 75%, and all those conditions. Now, they have the same clawback rule like we talked about earlier, and at least within 2 years, they have to maintain the same position. Like if one business is transferring a capital asset to another, they cannot shift it within 2 years to another company, because otherwise, imagine a 100 million property is given to another member of the group for, at a net book value of, let's say, only 60 million. So otherwise, the CT will trigger on that 40 million excess amount. But because they applied for this qualifying group relief, within the group, they are not then exposed to. So they have to comply with these clawback rules. Otherwise, again, businesses can take unfair advantage and GAR will still kick in. It is also related to Article 37 and 38. Like, once these conditions are met, like the loss, they can also utilize. So if the ownership interest directly or indirectly in a qualifying group is more than 75%, so tax loss, one company can give its tax loss to another, provided that the conditions are met. So let's move on to tax grouping. We already talked about this earlier in the presentation of Angela. So let's not spend too much time. It's just that complications I would like to highlight. Because the group, once the tax group is formed, they will be doing only one filing from the parent, and the liability will be joined on the group companies. So the threshold, again, the thing is that up to 375, they can only avail one of that. However, if all of them were registered as separate entities, so each entity would be paying no interest up to a taxable income of 375. Now, in case of tax grouping, so this position needs to be evaluated. This is one important concern in the tax grouping. Now, overall, see what happens is that, for example, taking the example from cricket, if you are a batsman and you are going for playing, the rules of the game you should understand. Then, if you are a batsman, it is up to you. You want to play a sweep shot, reverse sweep, cover drive, it's absolutely your call. But you have to abide by the rules for the game. Uh, so here again, if you are forming a tax group, you must follow the rules which are established and make sure that you do not violate the GAR provisions. So let's talk about this foreign tax credit. Foreign tax credit, of course, if your company is doing business in other countries and where it gets taxed because you are generating income there, and it doesn't matter whether you have double tax, treaty with the other country or no. Currently, UAE has treaties with almost 80 countries, but it doesn't matter if you have the proof. Then foreign tax credit in the form of withholding tax or income tax that is paid in a foreign jurisdiction, it acts as a tax reducer. So what does that mean? Tax reducer basically we will see in subsequent slides that when we move to the sixth section of the tax filing, this is where this kicks in. This will act as a tax reducer. So whatever you have paid there, if you have paid, let's say 15%, you can only claim up to 9%, which is the tax rate in UAE. So what are the eligibility for the foreign tax credit? You can see on the left top that you are a resident, UAE resident, juridical or natural person, and you have foreign income and the tax is paid. This I already talked about. And it is imposed by the foreign government, of course, and it's mandatory. So these are the documents on the right corner. You can see these are the documents that you have to have if you want to take benefit of this tax reducer, which is those certificates, because when tax is withheld, normally they issue the certificate for that. And there is proof of payment, breakdown of the income and calculations, and there is evidence of linked expenditure. So all these documentation one must have in order to take benefit of this foreign tax credit. So we briefly talked about this SMEs and the large corporates. So this just summarizes this overall aspect of it. Of course, the SMEs, they do not have those very well trained so to speak, in comparison to the large corporates tax teams. Firstly, they cannot afford because there has to be a business case, but they need to make sure that the staff that they are well trained enough to ensure that the company is in compliance. Otherwise, penalties are hefty, and normally it is said that the cost of compliance is less with the case otherwise. So for the SMEs, you can see, all the various aspects, and you have to take care of all these things: record keeping, audit risk, all these points, one way or the other, are already covered by Angela. So just to mention, for the large corporates, if they fall in that 3.15 billion dirhams range, they will have to follow Pillar 2, which is 15% effective tax rate that they have to pay. This is the main difference between SMEs and the large corporates. Now, just to summarize, while one must read the overall law, but these are 34 articles from the 70 list of the articles that we have in the law that are related to the SMEs. So these must be read. As you can see, some of them are related to the TP 34, 35, and 36. And overall, these are predominantly related to the SMEs. Overall, one must or one should go through all of them, but these are the specifics related to the SMEs, 34 of them. So this takes care of the first section. Now we will be talking about the corporate income tax registration. What is the process? Then once the registration has taken place, we have to then make sure that we are maintaining proper records and the checklist. Then comes the time of the return filing, which is the peak time right now. We are just left with 9 more days to make sure that the company is in compliance with the requirement. And then, of course, this is the same timeline that the payment has to be done. And if a company messed on any of the above 4, then they will be exposed to penalties. Now, before we go to the registration process, who is required to register? So there is a confusion between the people when the natural person has to register and who is a natural person and all that. So here you can see this is the classification which when you go on the Imara tax portal. So when you are registering for the corporate tax purpose, then the taxpayer detail you have to insert there. So these are the types of person that have to register. So natural person is required to register if the turnover in a Georgian calendar is more than 1 million dirhams, then they have to register. And for the legal person, they have to register. And you can see the categories, you can see the entity type and entity subtype. These are all derived information from the Imara tax portal. So this table just summarizes of how to go about and who is required to register and how to go about the registration. We will see in few minutes. Angela already talked about after you have a trade license, within 3 months, you have to register. If there is any update, let's say your location or address for the business is changing. So you have to update within 20 business days. You must notify the FTA. Then return filing, of course, 9 months after the tax period ends. And in case when the business ceases to exist, they have to make sure that they do the deregistration within 3 months of that time period. Otherwise, again, there are penalties. So what are the essential documents for tax registration? So you go on the Imara tax portal, then you must have these documents with you. First thing you do is that you create one entity or taxpayer. Then for that, you have to have all these documents and all this information will be asked from you and you have to upload this information. Trade license, of course, certificate of incorporation, definitely, Emirates ID, passport of the owner, all of this information is needed that you must be having handy with you. So if you have this, you will be able to take care of the registration process. Again, we already talked about these thresholds, so let's move on. So this is the CIT return filing. We said that we are now registered. After the corporate income tax registration process has taken place, we need to make sure that we are ready for the filing. So what is the process one must follow? So you are registered. Now you need to make sure that you are in compliance with IFRS in terms of maintaining your books. So you need to make sure you have all the invoices. You need to make sure that if you are operating in UAE, for example, you follow the VAT regulation when it comes to the tax invoicing. And basically that will take care of your output. So with the introduction of corporate income tax, this will also take care of your expenses because VAT was there already 5 years ago, 2018, so 7 years ago from the time we are talking about now. So top line was already covered. The government knew about your top line. Now they will review your expenses. And in future, in 2026, we are going to talk about e-invoicing. So everything is going to be captured. So there is there is limited amount of sorry, my screen is visible.
Yes, it is.
Okay. So the next thing is that analysis of the options. So if we are preparing, we need to make sure that we evaluate the option. What do I mean by the option? There are so many elections that one can do which can help the business to take the tax positions which are in their favor. Then you can do the mock tax computation, which will help you to determine what cash flow requirement you will have. So subsequently, information gathering and filing of the tax return. So these are the essential documents. Now you are on the Imara portal. They will ask you these information. Your financial statement. If you are a company making more than 50 million top line, you must have audited financials. They will ask about your average number of employees and details of the transaction with the related party. You must be ready with those schedules. Next, we are going to talk about the essential schedules. So in case if you are a free zone person, you have to maintain and prepare this schedule, and rest of the schedules every entity has to do. So these are related party schedule, loss, tax loss schedule in case if you are going to utilize that, unrealized gain and losses, and transitional rules and other schedules. So all these schedules have to be ready before you approach the Imara Tax portal and where you will feed in the information. Now, this basically slide covers almost everything that needs to be done on the Imara Tax portal. First, taxpayer details at the time of CIT registration, you already inserted. So point number one, you can see one are dark blue and one is light blue. So light blue is related to free zone. If you did not opt for that, they will ask you towards the end of taxpayer, are you a free zone person? If the answer is yes, then it will open up and you have to update that schedule. If you are a mainland entity, you have to go through all these 7 steps, the dark blue ones. Then you have to, point number 2 is elections. 4 categories will be there. Realization basis, you have to decide. So qualifying group relief, restructuring relief if you are taking and transitional rules. So these are the 4 categories of elections that you can, they will be asking questions about that. Accounting schedule is from your profit and loss statement, statement of other comprehensive income, and your balance sheet. Once you are ready with that, you will be able to insert information on this schedule. Accounting adjustment, this is step number 4 in your filing process. What does this include? So it will ask you questions like, are you following equity method, IAS 28? So investment in associates. So for that, there are certain requirements to make those adjustments. Then we talked about realization basis. This is one of a very technical side to it. It requires more in-depth understanding. And if you have good knowledge of IFRS, especially in a market like UAE where there are investment properties. So if you are following IAS 40 investment property, you must be very careful in how you apply these realization basis. Then there are transitional adjustments. Exempt income falls under accounting adjustment, and international aircraft. So this is based on the principle of reciprocity, wherein if a similar benefit is given in the other country, so they can make that adjustment. Then there are other adjustment. What are the other adjustment? Other adjustment include they will ask you few questions there that you have to feed in the information. For example, non-deductible expenditures. There are a few categories of those expenses. I'm just going to wrap up. I'm just approaching towards the end. Just give me please 2 more minutes. So in the other adjustments, we will be talking about all these non-deductibles that will be adjusted. Interest cap, we already talked about that. That will be taken care of. And then we have qualifying investment fund. These are all the part of other adjustment. Then it will show a tax liability. So tax liability in section 6 on the top will be shown. Once these 5 steps are completed, tax liability will be shown. Then we said that, whether or not we can take advantage of Article 37 and 38 for the transfer of losses in the qualifying group. That comes here in this section number 6. We talked about foreign tax credit. This will also come here. So these are the tax reducer. Ultimately, in the end, we will see the tax liability auto-populated once all this information is inserted. The final step is that we will They will make sure that we review all the information, what was filled through point number 2 to point number 6 will be shown here. It will ask for confirmation and then you will proceed. Subsequently, you decide if, for example, by 20th of August, you already completed this process. From that time until 30th of September, you still had time to pay. You can pay, you should pay sooner, no need to delay this. So this part has already been taken care by Angela, and 7 years and all these documents we already talked about, it's a repetition. These penalties, briefly, we already talked about it. The last three, I'm just going to talk about them. For example, if the FTA decides to go for an audit, and that might happen, let's say 1 year or 2 years down the line, if you did not maintain your records properly and the tax audit comes and you are obstructing that audit, there is a hefty penalty of 20,000 dirhams. Now, another main issue with the companies is that, let's say they have a mistake in this return filing. Again, mistakes can happen, but you need to make sure that you are very vigilant while you are doing this. In case if it is done by in-house team, then they must be very diligent in their process. And if it is done by external consultants, still they will ask you whether you are okay, like as a head of the finance function, they will ask you, are you okay with the preparation that we have done? So again, they will make sure that you get involved. So that's where this point, referring back to what Angela also mentioned, that training is very important. Awareness of the tax law is very important. The last one here is tax evasion. We mentioned it earlier also, that this is a criminal offense, and it must not be taken lightly. If somebody is trying to do that, they might be getting into some serious trouble. So just to conclude, uh, prioritize, prepare, and then file in timely manner, and make sure that the staff is trained. Although we are approaching the deadline, but as they say, it is never too late. One must be aware of most of the regulations that are there, so at least for their business, so that they can take the right measures, so that there is no 11th hour adjustments, because a stitch in time saves nine. With this, I'd like to end my presentation, and thank you for everyone who attended this. Thank you.
Thank you so much, Umair. It was very informative session, and we now know how to approach the corporate taxation, and it's already like on our heads, like it's the deadline is approaching. And now we'll quickly move to Q&A session, and I would like Mr. Arshad, I believe you have already summarized a few questions that you can share with both of the speakers, and they can then answer it. I request that we briefly answer those questions so that we can conclude the webinar on a timely manner. Thank you.
Thank you, Asim. Now we will move toward our next session. It is question answer. I prepare the questions from the audience. So I will start with Miss Angela. The first question, if you can answer, is especially related to this foreign tax credit. One person asking, they have the company branch in foreign country, wherein the UAE does not have double taxation treaty. Can they still claim the FTC?
Well, that depends a lot about the election that the company is doing. If the company is electing for the permanent foreign permanent establishment to elect to exclude it, then the condition are has to be met, and also the foreign tax has to be 9% in the foreign jurisdiction, and then the branch income is going to be excluded. Therefore, no foreign tax credit will be applicable. But if the company is not applying for an exemption, then the company will have to include the foreign branch income in UAE calculation, and they can claim foreign tax credit. But as we have discussed before in my representation, only 9% of that is not possible to carry forward any tax that has not been deducted in the taxable period. It will be completely lost.
So next question is, are domestic related party transactions really going to be reviewed in the first cycle?
I'm sorry.
Yes, uh, I will repeat the question.
Domestic. Yeah, please.
Domestic related parties transaction really going to be reviewed in the first cycle,
Yes, the
exactly
response
after
is
this
yes.
30th
Yeah.
September.
Yeah, definitely they are going to be reviewed because they are going to be part of the transfer pricing on which the FTA is going to be putting a high accent. Therefore, you have the possibility to compare this domestic transaction with internal transaction, and then you have to move and compare them with the market transactions. So the answer is yes.
All right. Next question I will ask from you. Will be the last, I hope so. Which areas will FTA focus on in their first round of audits after September 25? Which area this FTA will focus if they will proceed the audit exactly
Okay.
after 25 September 25?
Um, I think one of the biggest focuses will be for FTA to identify the registration. They have a lot of methodologies now to identify through the bank immigration data and also your VAT returns, the entities, and also their focus will be to identify the foreign entities that are obliged to register in UAE. Another area will be transfer pricing for sure. And the third area, very important, it will be qualifying free zone persons and the conditions that are going to be met in order to prevent the shifting of the taxes to zero rate. It will be important to have the financial audited financial statements, and another area it will be the compliance with the deadlines. So you have to pay the taxes because law has been implemented in order to increase the cash availability for the government.
Thank you. Thank you so much, Angela. Now I will move toward this Mr. Umair. Uh, I will start with one first question. This especially, can sole proprietorship or incorporated partnership be part of a tax group? Sole proprietorship or incorporated partnership can create a tax group.
So we talked about this in one of the slides that in order to form a tax group, these are between resident juridical persons. It cannot be even a branch of a foreign entity which can be part of this tax group. These have to be resident juridical persons. So to answer your question, a sole proprietor, natural person, and partnerships, they cannot form a tax group. It has to be a resident juridical person. And there is a process to it wherein the parent entity that has to go with the registration. And there is a process when FTA has to approve. So these people cannot be part of that tax group.
Okay, next, that is the common question. Still people, they are confused. Who has to register for the corporate tax? As one question is there, is corporate tax registration mandatory even if any business earns below 375,000, like
Well,
small business?
correct. So what happens is that when the VAT law was introduced, the government basically gave the opportunity to the businesses if they had a turnover of less than 375,000, they were not required to register. They could do it on voluntary basis, but they were not required. It was not mandatory for them. So this caused some confusion for some of the companies. Now, for the juridical persons, they have to register this, whether they are having income of less than 375, irrespective of that, they have to register. For natural persons, the threshold is more than 1 million. So for natural person, if they are conducting business activity and they are generating state source income, that is UAE source income, in a Georgian calendar year, that's where they have to register and they have to pay corporate tax.
Yeah. Okay, the next question from the audience. A person who is living outside UAE but has a company registered in free zone of UAE, will be he treated as a resident of UAE, and what tax implications are applicable? It looks clear that if he has a company in UAE, he must be a resident, right, Mr. Umer?
So the residency status, it depends. Firstly, we need to establish, like it's a entity that is registered here, right?
Yes.
So if they have registered an entity in a free zone, then if they are doing the qualifying activities, anyways, they have to register. So they have to fulfill all the conditions. They must have audited financials. They have to be registered in a timely fashion, and all the conditions that they have to fulfill.
The next one question, Miss Angela, if you allow me, this is related to you. One
This will be the
person
first
asked me,
one.
yeah, this early filing is equal to early visibility. What it mean?
Yeah, early filing means that you are very diligent and you are very structured in your reporting. But of course, filing very early, FTA will have a lot of time to look at the filing, and you will be subject to scrutiny because everybody is
Thank,
filing on 30. It will be a multitude of filing, and you will not be visible. Filing early, of
thank you
course.
so much. Thank you so much, both of you, for the nice question taking and giving a proper answer. Over to you, Asim. Now you can conclude, please.
Thank you, Achusar. Thank you for taking these answers, both the speakers. And now you guys can hear me, right? I'm audible.
Yes, audible.
So now I'll move to Mr. Muhammad Rizwan, Chairman, UAE Branch Council, for the vote of thanks. And after that, we'll close the webinar properly. So over to you, Mr. Rizwan, sir.
Hello, everyone. Very good evening.
Good
Thank you so
evening.
much, Mr. Asim. On behalf of UAE Branch Council, I warmly congratulate to you and your TSPD team for arranging such an amazing and first webinar series on a very important topic. I also express my thanks to Mr. President, Mr. Ghulam Mustafa Qazi Saab, who have joined, and appreciate UAE Branch Council team, give honor to our honorable guests, which added a value to today's webinar. A special thanks goes to our honorable guest, Mr. Angela, and Mr. Muhammad Umair for their valuable time and a detailed insight of this long awaited topic of corporate tax and the return filing. I equally congratulate to all the members who have joined, contributed for the success of this webinar. I will not forget our head office team, Mr. Asim, Mr. Sham, and Ms. Hira, who have always supported us and make our webinars very successful. At the end, thanks to all of you, especially the guests, who have made this webinar very successful and informative. Back to Mr. Asim Shahzad.
Thank you, Chairman Saab. So now we will formally conclude it, and I want to thank you to all our attendees as well. So they took like their precious time, and it was a day, it was a Sunday night, and tomorrow they all have to go to the office, and still they are here with us for this session. Thank you again to the speakers as well, and I hope this session brings some clarity on the UAE corporate tax part, and it is the first of the series that we are planning to do, and I hope in future as well you will be getting some notification from our end, and we'll provide you with a few more sessions on the corporate taxation and also the on other relevant topics. So just want to give you as an icebreaker or something, that the next one is coming up is on the AML as well, and inshallah we'll see you over there. Thank you so much, everyone. Thank you for to the head office team as well for giving this support on the Sunday. Thank you, everyone, and have a
Thank you, Mr. Angela, Mr. Umer. Thank you, everyone.
Thank you.
Have a good evening.
Thank you so much.
Thank you. Bye-bye.
Take care. Bye bye.